Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive uses natural and artificial intelligence to educate investors and provide actionable insights for all markets, from rates to FX to commodities. For our latest insights, visit macrohive.com. Before I start my conversation with this episode's guest, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up to our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macrohive.com. Finally, and my third request is that if you are a professional or institutional investor, do get in touch with me. We have a very high-octane strategy and analytics offering that includes access to our world-class strategy team, market views, AI models, and much, much more. You can email me at bilal@macrohive.com, or you can message me on Bloomberg for more details. So greetings and welcome, Jay. It's fantastic to have you back on the podcast show.
Thank you, Bilal. It's great to be here again, and certainly no shortage of things to talk about, right?
Absolutely, yeah. And as we come into, it's December when we're recording this, and obviously it's 2026 on the horizon. In your recent notes, you talked about 2026 being a continuation year for your tripolar world thesis. So maybe we can start with what is that, just for the benefit of our audience, what is this tripolar world thesis? And then we can get into the details of what this means.
Certainly, and I appreciate the opportunity to speak to your audience and have this and have the chance to talk about TPW, which stands for Tripolar World. And so Tripolar World is a thesis that I developed now 15 years ago. I started to write about it 2010, 2011, really in the aftermath of the great financial crisis, where I think the world and myself were kind of searching for, okay, what's next, right? Globalization, as we knew it in the 2000s, it clearly died with the financial crisis. Nationalism really doesn't work, and clearly was proven to not work with Brexit a few years later. And so the tripolar world basically is a thesis that argues that regional integration or regional deepening in the 3 main regions or 3 poles, thus tripolar, of Asia, Europe, and the Americas are going to be the driving force or ordering system, shall we say, for the global economy moving forward. And I think subsequent to that, as I mentioned, Brexit was kind of a confirmation. Then you had COVID and all the focus on reshoring and nearshoring. And now we have AI and competition between China and the US and tariffs and all these things, reinforcing again this idea of, okay, we need to have what we need close by. And no country has everything, which is why we think the regional structure makes a lot of sense to contemplate this. And it really then becomes, okay, who can leverage this process most effectively? And so the way, and for us, how do we follow it, right? How do we invest in it and things of this nature? And so the tripolar world, and TPW Advisory is tripolar world. That's the thesis: regional deepening and integration in Asia, Europe, and the Americas, forward operating system for the globe. Now, what do you need to kind of do this type of work? Global macro, as we call it. We feel like there are 3 critical factors that one needs, or functions that one needs to be successful in doing this over time, which is certainly our objective. And the first is a framework. And so for us, the tripolar world is our framework, right? This is how we view the world. And it's really helpful because it forces us to effectively spend almost as much time thinking about Asia or China or Europe and Germany as we do about the United States. And so I think that's a real differentiator vis-a-vis lots of our peers and competitors.
That's absolutely true. I mean, so many people I speak to just focus like 90% on the US, and it's a footnote for the rest of the world. And so you're absolutely right in terms of having this balanced approach.
And then we take that balanced approach and that framework, and we have a process. And so our process is to write every week. And I learned this back in the day as a sell-side strategist at Morgan Stanley, and we had Barton Biggs and Byron Wien and Steve Roach, all these famous names writing every week. And that's where I learned the discipline and the value of writing regularly. And so the discipline obviously is, okay, you need to write once a week. And the value is that it keeps you on the front edge of kind of the information flow and the thinking. And I believe that's really ever more important as the pace of things picks up, as I think it's pretty unarguable that things are moving faster, market is discounting things more quickly. And so being on the front foot, as it were, by writing once a week is really, really useful. And then we write, so we have our Friday musings, as you know, and then once a month we do a deep dive monthly where we write 6,000 or 7,000 words, somewhere between 30 and 40 charts from 20 or 25 different independent sources, a real deep dive on kind of what we're focused on at that moment. And that prepares us for the third step, which is our structure. And the structure for us comes from our model portfolio delivery service, where we offer clients a global multi-asset model, or GMA, and a TPW 20 or thematic model for clients to use. And I just want to spend a minute on that thematic model because I think it's really, really important. And namely because that's benchmarked 50% to future innovation, 50% to alternative energies. And so that, plus part of our monthly, every month being focused on climate, has required us to really follow and understand the whole build out of the renewable energy space and how that's moving into now kind of an electrification process, and how cheap renewable power is becoming a competitive advantage for countries as they contemplate AI, data centers, and the tremendous power requirements that those data centers are bringing to the grid in a very, very short order. And it really sets us up for thinking about the next couple of years, where we tried to outline some of this, as you say, in our 2026 outlook, which was titled Newtonian Investing. And we went all the way back to Newton's first law of motion, which is that objects in motion tend to stay in motion unless they're altered by an alternative force. And it was really just a shorthand for us to say, we think the trends in 2025, both in terms of global economy and global financial markets, are going to be sustained and continued in 2026.
And if we, listening to you there and the framework and everything, if we start with the US, obviously a huge theme this year has been the whole AI story, data centers, CapEx in the US, which is incredibly large. And then there's been all the hyperscaler, Mag 7 and so on. How do you look at that story, in your framework? Because there's an energy component to it, there's an innovation component to it. The US apparently seems to be a global leader, but then obviously there's China, close behind or ahead, So how do you see that theme?
Yeah, it's a huge one, right, Bilal, and been kind of bubbling for a while, and it's going to continue, again, a continuation. So, there's a number of ways we can approach it, but I think I'll go down this route and say that, for the last several years, we've been talking about a global growth long cycle. Okay, really started talking about this in 2022, pushing back against the consensus for recession, arguing that in the tripolar world setup, each region is going to be spending aggressively on three existential things: AI, defense, and climate. And that spending by each region is going to sustain a global growth long cycle, okay? And it's going to require both fiscal policy, so we talk about being in a fiscal age, right, where governments have to spend, and we talk about a new industrial policy where you need both public and private cooperation to be successful in AI, defense, and climate, right? No company has enough money to do AI by itself. No country, no government has the requisite industrial capacity by itself as a government without using private sector to build the data centers, to build the drones, to build the solar panel space and the battery build out, et cetera. So there's a real need for public and private coming together, industrial policy to compete in all of these spaces. And they're kind of all bleeding together, right? And becoming one kind of innovation-driven global economy or regional economy competition. And so as we think about AI and the competitive edge and the CapEx and all that stuff, to us, just going right to the heart of the matter right now, is the game is, again, moving very fast. And China has, in part, been provoked into demonstrating its peer nature with the United States, right? In kind of two ways, right? The U.S. has spent the last several years trying to limit China's ability to access cutting-edge semiconductor chips, right? And so you had the huge Mag 7 and the U.S. being way ahead, and then you had DeepSeek, right? Come out of nowhere, demonstrating that China has, quite good capacity, right? And if you look at today, open source models as judged by third-party independent analysts and think tanks, China has the bulk of the world's leading open source large language models, right? US
That's absolutely right. It seemed like early on Llama was the leader, but very quickly the Chinese have taken over.
And China's making a bet that open source is the way to go. US, of course, closed source, and so want to keeping it to itself. In a way, you can think about it, or we think about it, from the perspective that the Chinese are kind of more engineer and builder focused, and so open is better because it scales to more industries more easily. And the US is more lawyer and kind of tech geek, and they're looking for the kind of killer app that can dominate the space. And so you have, in a way, kind of almost not ideological, but almost cultural kind of approach. And then you have, as we see it today, China, through the interaction with President Trump and President Xi in South Korea a few months ago, demonstrating peer-to-peer capacity, right? U.S. thinking that it could pressure China by withholding cutting-edge NVIDIA chips, and China countering with rare earth dominance, demonstrating to the U.S. that, in fact, China can withstand a lack of chips more than the U.S. can withstand a lack of rare earths, and therefore now kind of peer-to-peer relationship. And within the semiconductor and AI space, the game has also changed. It's no longer, in our view anyway, a game of who has the better chip. It's a game of who has the cheaper power. And this is where the renewable AI, climate, all this stuff is blending together, because China is developing and it basically becoming, as we talk about it and others talk about it, it's not a concept original to us. China is becoming the first electro state. It is developing its electrification, its power grid in a way that allows it to have way cheaper power, renewable power, than the United States. And China is leveraging its cheap power advantage to develop its compute power using lower quality chips, but more of them, and thus leveraging the power advantage it has to counter the US advantage in having higher quality chips, but running into a power limitation very, very quickly. Whereas you can read, and I was just reading the other day that the Q, being in London, you'll understand the term Q.
We like our Qs over
Yeah,
here.
exactly. You guys like the Q. Well, you should come to the US because the queue to get connected to the various grids in the United States is now stretching into years. And so there is in this, how to think about the whole Mag 7 AI, et cetera, there is a power component to it, which is only now being appreciated and understood. And we think that is going to be appreciated and understood even more so in the coming years. And so we developed in our most recent monthly, the 26 Outlook was in October. We like to get ours done early. In November's monthly, we talked about iterating towards a new growth model. And that new growth model consists of kind of two things, two basic requirements. One is cheap renewable power, and that is becoming available as solar becomes ever cheaper and battery technology evolves such that you now have the capacity, and increasingly what's happening is you have a solar field and a battery unit put together right from the start. The two are now a package, basically. And so that process is allowing different countries to start to provide themselves or present themselves as regional attractive locations. And I'll give you just the most recent example, comes from today's Bloomberg, where Bloomberg reports that ByteDance has just agreed to invest close to $40 billion in an AI data center in Brazil. And why Brazil? Well, because Brazil has one of the cleanest power grids in the world, where roughly 95% of its power is clean, renewable energy. Much of it hydro, but increasingly solar and wind as well. And it also has some of the best connectivity to the United States via submarine cables stretching from the northeast of Brazil up to the U.S. East Coast. And so in our most recent monthly, before this even was public, we talked about how Spain has become one model. Spain has leveraged its cheap renewable power to have much lower power costs than the European average, significantly lower. That has led to Spain becoming a preferred destination for Chinese EV and solar manufacturers, generating better growth, some of the best growth in Europe, leading to a double debt upgrade this year by the rating agencies and one of the best performing stock markets in the world. And so we look at Brazil and we see Brazil starting to leverage its renewable capacity. And we were just in Brazil and wrote a piece a few weeks ago titled Brazil Prepares for the Future, prepares to meet the future. And part of this future is cheap renewable power plus a growing population, either through natural population growth or immigration. Because as you know very well, the only way an economy can grow is if there's either a growing population and or productivity. And productivity is increasingly hard to generate as countries become more service driven. And so there's we believe, a new growth model starting to materialize out of this intersection of AI, power, climate, innovation, etc.
And on the power side, I mean, one people often point to the fact that the US is a large oil and gas producer, so it has a natural advantage over the countries. But from the way you're talking about things, that's not enough. That's not what you mean by power.
Can
you talk more to that?
Yeah, the solar and wind is much, much cheaper, much more competitively priced. Oil and gas is very, very inefficient and much more expensive. And so as you look around the world, and we have, I encourage your audience to take a look at our Substack where we publish our work these days, the Tripolar World. And we showed a tremendous number of charts demonstrating the relative value and the cheapness of solar versus any other source of power. It's really solar plus storage is now, as I said, it's almost becoming packaged as one. And the battery, and they feed on each other. The capacity of batteries to provide massive amounts of industrial scale power for hours is becoming ever greater as price points break down, and you have a capacity to put the two together and power, clean power for years and years from the sun, as opposed to having to buy oil and buy natural gas and ship it and refine it and all these other things. And very importantly is the grid and the connectivity. And very importantly, we like to use the phrase, the digital devours the physical, because AI does not exist without silicon, without water, without copper, et cetera, et cetera. And so there's a tremendous opportunity, in our view, to invest and participate in this process across the digital and the physical in the U.S. and for us more in the non-U.S. equity markets, and particularly in emerging markets. We have in our global multi-asset model, big overweights in EM equity, in EM debt, in commodities. And funnily enough, for all the talk we've just said about solar and clean and renewable, we have very big positions in energy, traditional energy, oil and gas, which is not going away, but is simply becoming the growth. The new demand is being met by renewable power. It's not being met by oil and gas. And this is now increasingly clear across the different segments of the economy, transportation, industrial, building. And again, the data is very clear. There's a group called EMBER, EMBER, where we get a lot of our information. I highly recommend them as a source to really understand this. And then, as I said, we had our monthly with iterating towards a new growth model in November, had 42 charts and tables. About 15 of them were on this renewable power and the electrification focus in the grid, and how the future is going to be won by the folks who have leveraged cheap renewable power. It's just such a competitive price point advantage. And so the U.S., sadly, rejecting this administration anyway, rejecting the renewable power opportunity and kind of doubling down. The most recent news over the last couple of days was that the Trump administration was going to significantly unwind the higher mileage requirements that had been put in place by the last couple of administrations. So in effect, doubling down on internal combustion engine vehicles, while the rest of the world progresses aggressively towards hybrid and EVs. And so the U.S. is sadly just, kind of stepping away from the game voluntarily. And that's why, we are using and have used for the last year or two the U.S. as kind of a source of funds.
And just on that, obviously there's been a lot of talk about the AI bubble. And so I'm trying to think about how to, because the story you're painting globally sounds quite bullish. It doesn't feel like there's a recession on the horizon.
Right. Then
we're hearing about AI bubble. There's all this so-called AI bubble. So everything's going to collapse, .com collapse and so on. So when you hear that, I mean, do you think we're in 2000? .com collapse? You laugh. Okay.
All right, I laugh. Very funny, quick story. I was a global equity strategist for Morgan Stanley in 2000. And I was on a trip to Antarctica in the spring. Morgan Stanley was sponsoring a movie, an IMAX movie on Sir Ernest Shackleton's endurance adventure. And I was Morgan Stanley's representative on that film crew. And so this is a true story. I am on a retrofitted Russian icebreaker in April of 2000 and get a call on this absolutely massive satellite phone that was literally like 1.5 feet And it's my assistant at New York telling me that the NASDAQ had fallen like 12% or something, and people wanted to know what I thought. I'm literally in the middle of Antarctica. I hadn't, been on a phone or in my desk for weeks. And all I can remember, Bilal, is that the sound of birds flying into the ship because of the lights. They were attracted by the lights. We were anchored off of South Georgia Island. There's absolutely nothing for thousands of miles. The lights of the ship, birds smashing into them and falling to the deck, and my assistant asking me over a crackling sat phone line, what do I think about NASDAQ down like 12% or 14%? So I remember 2000, and 2025 is not 2000, okay? Virtually everything is different. Then you had unproven companies. You had no revenues. They were building supply in anticipation of demand. Today, you have some of the world's best companies making oodles of money, completely unlevered, AAA credits that are trying to meet demand and can't meet demand, and growing earnings at 50 or 60% per annum. So that NVIDIA, as the poster child for this, today trades at a 20% discount, maybe not today, after the last week or so, probably 25 or 30% discount to its 3-year forward PE average. In other words, while the concept has become more proven over the last couple of years, the leading dog, the poster child, trades at a 25% discount to the average forward PE over the last 3 years. So, another example is this whole private credit thing. Oh my God, private credit. We're going into a huge bust up. We just added to our global multi-asset model in late October, early November, a position in this space, in the private credit space. And guess what? Over the last, and this is the value of the structure of having a model portfolio. We know exactly what our expectations and recommendations are doing because we track them. And so over the last 5 weeks or so, this position has outperformed Barclays Ag. Barclays Ag being the benchmark for the fixed income space. So, you have to have an understanding of what's already in the price and how quickly things get repriced, as I said, very, very, very fast these days, and then where the opportunities lie. So this particular instrument, its symbol is BIZD for anyone who's interested, is a business development corp. Blue Owl, which I'm sure you've heard of as the poster child, is a 10 or 12 position in the percent position in this BIZD, and it has a 12% yield on it. And it's up terms, outperforming the ag over the last 5 weeks. So what does that tell you? Every day there's a story about Blue Owl and private credit and AI, and yet the instrument is outperforming. It tells me that it's already in the price. And I've got the opportunity to just sit and probably have a 20% plus return on this over the next 12 months. 12% yield, and it fell from 17 to 14, and today it's at like 1480. We bought around 14, which if you go back and look at a chart, is exactly where it fell in April, exactly where it fell, the last time there was a worry. So, technical analysis is very useful in understanding where things go to. And today, in part, as you said, the macro is so uncertain that technicals are being used much more aggressively, particularly by the models, right, and the algorithms which drive the day-to-day trading. They all go to the same spot immediately. And that spot, you can go back and look at a 5-year chart of BIZD. It's hit that $14 level 4 or 5 times. And so that to me is a very nice level we're long, and I think that a lot of this stuff is completely overblown.
So this whole .com parallel just is all wrong for the reasons you mentioned. It's just the wrong kind of reference.
Completely wrong. And the last thing I'll say, and I'm sorry if I went on a little too long there, but the last thing I'll say is that China is where we're expressing our tech enthusiasm, right? Because China has, as we've demonstrated, is a peer to the U.S., is developing its own tech stack, what we call splinternet. Again, something we've been writing about for years, part of the tripolar world. China is developing its own tech stack, right? U.S. developing its own tech stack. AI only reinforces that. And yet you can buy the China tech stuff for a fraction of what you pay for the U.S. stuff. It makes absolutely no sense. And so one of the things we're thinking about is that now that China and the U.S. have established peer-to-peer relations, and the market is effectively pricing things, some things like Chinese debt trade right at or better than treasuries. The equities are the thing that's misvalued relative to the two countries. Potential rapprochement this coming year when Trump goes to Asia, China, and Xi comes to the United States could signal an opportunity for U.S. institutions to start to buy Chinese equities again, which would be very, very bullish because they don't own much at all. And
what did you make of the China 5-year plan, the new 5-year plan that they disclosed recently?
Yeah, I think, look, China, we like to have, when we make, big bets, and we would say we have a big bet in China and have for several years. You and I have talked about this before. We can go back and look at the last time we did this. Talked about K-Web quite positively then. K-Web's been a big outperformer. We think that China is moving very, very aggressively. China has the best world-class industrial policy structure to leverage what needs to be done. It's developing its own process. It's leveraging its own competitive advantages in the power space, as we said earlier, relative to AI. It's developing better and deeper and tighter relationships with the rest of the world, particularly Southeast Asia and Africa. That's where China's export growth is going. It's been able to move from depending on the U.S. consumer to now having a much more diffused dependence on the fastest growing regions of the world, which are Southeast Asia and Africa. And those are going to continue to be the fastest growing regions of the world. And so I think China has talked about in this 5-year plan, continued self-reliance, and also really developing and diffusing technology through its economy. And so two things. One, we like to have multiple drivers to big bets. China's a big bet. EM's a big bet. First is Trump rapprochement. Second is China defeating deflation. And so we think that their anti-involution campaign, which is two-pronged, one prong, reduce supply, very good for earnings. Second prong, drive consumption, very good for the economy. Defeating deflation, reducing supply, growing earnings, growing nominal growth. Some people understand that real growth is higher in China than nominal growth because of deflation. It usually is the other way around. Nominal growth is higher than real growth. So we think that is going to switch in the next year or two. So we're quite constructive on the earnings outlook for China. And so defeating deflation. And we're watching very, very carefully, and we've written about this, the single most important global macro number in the world is the yield on the China government 10-year bond, because that will signal whether or not China is successful in defeating deflation. And so that's something I look at every single day when I start my day. I look at a bunch of different indicators. That's one that we look at. I can tell you today it's at 1.86. When we started looking at it, it was at 1.6%. We think it's going to go north of 2%. And we think that China is going to be successful in defeating deflation. And China has that builder mentality, that open source AI model mentality. And they want to diffuse this technology throughout its economy while at the same time leveraging its renewable power. The expansion of clean renewable power in China is just absolutely unprecedented. And you have to really wrap your head around how big it is and how fast growing it is and what it means as a competitive edge going forward for the next several years. So we're, as I said, we're quite constructive on China.
And then how about Europe? I mean, you mentioned Spain earlier. People like to beat up on Europe, saying there's no AI strategy. They don't have any oil, too much, regulation and so on. Right. What do you think on Europe?
Well, Europe, our thesis has been, as we talked about earlier, right, this fiscal and monetary policy working together. So global growth, long cycle, continued spending, the continuation argument on spending on AI, defense, and climate, requiring aggressive fiscal, as well as one of the world's biggest rate cutting cycles. And Europe is at the epicenter of both of those, right? You have Germany, the big engine for Europe traditionally, finally spending some money. That's going to kick in really in 26 and 27, voted in 25, but the fiscal hit, the boost, it's not a hit, the boost is going to come in 26 and 27. At the same time, the ECB has cut rates significantly. You're starting to see the outlines of a credit cycle emerging in Europe. You look at the banks, we've been a long multi-year holder of EUFN, been absolutely a rock star. And again, this year, far outperforming the broad European equity, still trades at a massive discount to the US equity banks. I mean, EUFN, I think, trades still under 1x book. In the US big money center banks are at 1.5 or more times book. So, there's more room to go, basically, in that. And so we look at Europe and people have to understand that, 1%, 1.5% growth is what you get when you have a economy with no real labor force growth and very limited productivity growth. And yet companies can make money because companies can improve their margins. And you're seeing that in Europe. There's certainly at the banks, they're doing a lot to improve their return on equities, the measures that bank analysts look at. European banks have gotten much closer to the US. You see the same in certain corporates. Europe has the opportunity, in our view, to do much, much more. What Europe needs is well known. It's been laid out by Draghi and others for the last couple of years. It's really, really clear what needs to happen. It's disappointing that it's not happening anywhere near fast enough. And so, Europe, I've been saying for years, has a chance to win the decade of the 2020s. We're halfway through. They need to kind of start doing things as opposed to talking about things if they're going to get in that game. Right now, I think it's pretty clear the winner is China. And the U.S. is, fighting for second or third place. But, we are more positive in EM. And I'll just make a quick aside, which I realized just the other day myself. If you look at ACWI, right, All Country World, which is our benchmark for the equity side, our global multi-asset model is benchmarked 50% ACWI, 40% Barclays Ag, 10% Goldman Sachs Commodity Index. If you look at ACWI, EM now is a bigger weight than Europe, including the UK. I was surprised to realize that. I would think most people would think, if you ask them, what has a bigger weighting in ACWI, Europe, including the UK, or EM? I think most people would say Europe.
Most people would say, yeah, absolutely, yeah.
The reality is the emerging markets. So Europe is being, kind of discounted by the markets because it's not doing the things that it could do around savings and investment, around innovation, around just making the single market much more single market, right? I mean, you can read every day in the FT that all the rules and regulations are basically the equivalent of a 50% tariff intra-country, which, is just ridiculous. And so Europe is not fighting and leveraging the fact that it's 500 million people and a $25 trillion GDP. It still acts as if it's 80 million people or 100 million people. Now, within that, Spain, as we talked about, Poland, as we've discussed in the past, there are different parts of Europe that are moving and embracing this upside opportunity, and they're being rewarded by the market. And so you would think over time, others would see that and would want to be rewarded too, because, there's a limit to what markets will accept in terms of government spending, right? France is finding that out. UK is finding that out. And so, you need now, we're switching from fiscal spending in some instances to revenue generation. And I thought the Katie Martin in the FT the other day had a great story on this. And she talked about maximizing, or I think it's maximizing private wealth or something like that. But the basic thesis was that countries are increasingly telling their big institutions to stay at home and invest at home to help us grow. And this, I think, is a big theme that's going to materialize and is slowly starting to materialize. And the U.S. is the biggest loser here, because the U.S. is the world's biggest capital importer. And if the U.K., Canada, Japan, other countries start to really press their big institutions to invest more at home, to help build out AI, defense, climate, all these needs, existential needs, while the public purse is kind of tapped out, private money needs to come in. That's A, good for those countries, arguably, and B, very bad for the U.S., which leads us to be quite negative on the dollar and quite bullish on non-U.S. equities and on commodities.
No, that's fantastic. Well, we've covered a lot of ground, so I did just want to round off with a personal question for you. I know from our last podcast, you talked about your involvement in college football. I didn't, at the time, appreciate your level of involvement. So just tell the audience once again, how you're involved in Duke's college football and how vibrant college football is and how your team is doing.
Okay, great. Well, that's a subject we could talk at for some time, but I'm excited because I'm thinking about my musings on Friday, and it is college football championship season now. These next couple weeks, conference championships this weekend, for example. And what wins championships is defense, right? Not offense. People like to score the goal in soccer, or throw the long touchdown pass, or have the long touchdown run. But what wins championships is defense. And the best defenses are kind of connected, almost as if like on a string. The coaches talk about players, the 11 players, it's 11 on a side in college football and pro football, American football. Coaches talk about all 11 on defense being on a string. So when the string gets tickled, everybody moves as one. And that's the mark of a really, really stellar defense. And so I think there's a lot of analogies between sports and investing, and connectivity on defense, as well as connectivity in the electrification process, as well as connectivity in the portfolio construction process, and this idea of investing across the AI space, all the way from copper to semiconductor chips to data centers to the grid is all connected. And so I think that's going to be the theme of the meetings tomorrow. You guys get tomorrow's news today. Football wise, I was a founding member of Duke's Collective. So some of your audience may be aware of the whole name, image, and likeness, or NIL focus in college athletics in the U.S., where athletes can get paid. That's led to a very exciting environment where teams can kind of move players around and people can change teams without having to sit out. That's called the transfer portal. And all of this in pursuit of appearing on TV, because the only thing that Americans will watch on appointment is sports. And so if you look at the top 50 most watched programs in the United States on any given year, 40 of them will be pro NFL games, 8 or so will be college football games, and 1 or 2 others. And so all of this, in the true American fashion, is driven by TV contracts paid to the conferences, which are made up of schools, which are therefore required to have a better team, to have a more appealing product, to be on TV more and generate more revenue. And so the collectives were put in place to be the intermediary between the player and the money. And now, because of changes in legislation, the process has changed to something called revenue sharing, where the schools are allowed to pay the money, and each school has a $20 million pot, shall we say, that they have to come up with. The school has to, come up with the 20 million, and they divvy it out to their different sports, and mostly college football, men's basketball, women's basketball, and then maybe baseball, tennis, soccer, lacrosse, etc. Now, just as an update, our collective and many collectives have closed as a result of the school now taking over the payment process. And so I'm not as involved as I was a year ago. We closed our collective over the summer, but still very excited to see that Duke is playing on Saturday night in the ACC football championship. It's the first time in a dozen years or so that Duke will play in that game. And the winner of that game is expected to be invited to the college football playoff, which is a 12-team playoff, which will lead ultimately to a national champion. And so all of this helps the school, helps the visibility, helps the students, all excited, camaraderie. Sports is a great connector of people. And as I say, I think it's got a lot of relation to how one thinks about the investing world. And so for me, it's been fun to,
that's great. It's a fantastic story and
bring
great
different stories together. And thank you for asking, and go Duke.
Go Duke, yeah. Final question: if people wanted to follow your work, subscribe to your work, and so on, where do they go?
Yes, exactly. Thank you for offering that for me to answer. We have a Substack called The Tripolar World, where folks can sign up and pay to be a subscriber to receive all our written work and other things, TV interviews and etc. And then we also offer a model portfolio delivery service, as we touched on, our global multi-asset model and our TPW 20 thematic model. And information on those can be found on our website, which is Pelosky.com. So Pelosky.com. And we look forward to hearing from all sorts of people.
I'll make sure to include links to everything. So with that, thanks again for such a comprehensive view and very thoughtful, outlook for the year ahead. And as I said, good luck with all the sporting endeavors as well.
Thank you, Bilal. Thank you. And congratulations on all the exciting things that are happening at Macro Hive, and you and your team have done a great job, and it's always a pleasure to join you and have the chance to have a long form discussion. That's global macro by definition.
Exactly. No, appreciate that. Thanks for the kind words.
So thank you for the opportunity.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. And of course, sign up for our free newsletter at macrohive.com. And this podcast is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information and although obtained from sources believed by MacroHive to be reliable, its accuracy and completeness are not guaranteed. Past performance is not guarantee or indication of future results. Third-party opinions expressed in this podcast are solely those of the speaker and do not represent the views of MacroHive, BGC Group, or any of its affiliates. And this podcast may not be copied or distributed in whole or in part without the express written consent of MacroHive. All rights are reserved.